very good day to you traders. I'm Rob from thelazytrader.com. I hope this finds you well. And today we're basically going to be talking to you about why we only trade end of day. And this is the style which we teach to our clients. The reasons might surprise you, certainly if you're new to trading. But as we shamelessly declare ourselves as lifestyle traders, simply using trading as a vehicle to get fantastic capital growth, then it suits us. So we can only trade from 10 minutes a day and go and enjoy lifestyle actually in the day and leave the market to move in the daytime for the intraday traders. Okay, so the reasons that might surprise you, certainly trading end of day only is flipping boring. However, the less emotionally charged the actual act of trading, the better it is. If we're cool, calm and collected and we've got a hard time for it to trade, even though we might trade fewer trades, we generally select higher quality, higher reward trades. And certainly when you learn our strategies, that will be the case. We spend less time in front of the computer. As I mentioned, we spend typically from 10 minutes every evening to half an hour every evening. And when you consider the gain or loss over the year divided by the hours spent in front of the computer, we've got a much better gain or less adverse loss, worst case scenario, than if we were spending hours in front of the computer every day. So we've got a much better synergy for our time spent. And put it this way, if you've chosen to trade the markets, the chance is that you're doing it to make a good capital gain and you're entrepreneur in that respect. So it's probably very unlikely that you're already that interested in the actual goings behind the market. So yeah, more time spent enjoying lifestyle to do the kind of things you want to do as much as possible and as quickly as possible. Your money is working hard for you. This is a big one. So that you've just placed your trades in the evening. It's taking you between 10 minutes to half an hour. You've set your orders up with your broker. You walk away. You go to bed. You get up. You have a life in the day. You do your thing. You go to the gym, meet friends, do this, that, and the other, whatever floats your boat. And you attend to your trades in the evening, GMT. Or if you're in Asia, you can do it first thing in the morning, which is actually a much better option if you ask me. You can always be in the opportunity flow. Now, this is a big one. Opportunities in the market are completely random. You get a disproportionate kind of range of wins and losses. Sometimes you might have to have a few losses in order to get a few wins. And certainly that's why it's important to be in the opportunity flow, what we call the opportunity flow regarding that. So you might have to realize 3 losses until you get a win of like between 5 and 10%. That's perfectly normal. But the daily time frame is the best way for us to always be in the opportunity flow. So whenever we can steal 10 minutes of our day just to look at the charts, whether it's first thing in the morning or last thing at night, that's far more attainable every day than if we're looking just to spend 4 or 5 hours in front of the charts every morning of every day. So it's a lot more realistic. We're humans, we're emotional, we want to live a good lifestyle, so why should we fight that? So the daily for us offers us the most efficient way to always be in the opportunity flow. You can always take advantage of seismic moves, like moves which equate to thousands of pips. Of course, measuring in pips is not the actual measure of your success. We do that in percentage here. But generally, the daily time frame is a much lower frequency of trading, and many people, including us, see the kind of sanity really in actually placing fewer high reward trades rather than numerous small reward trades. It's better for your health and sanity, dare I say. Okay, so emotion is taken away trading the daily. It's a much higher time frame. You see the movements a lot less, even though you might be profiting from them. You don't see these horrible violent spikes like intraday traders do. You're not susceptible to news. That's another big one. And actually, the news is a huge one because it means that you can actually not really have to worry about the news. The news rarely affects the daily in an adverse way. It might cause retracement against your position, but it generally won't spike you out like you would on any smaller time frame because you've generally got a much bigger difference between your entry and stop loss. And so for that reason, end-of-day trading is a lot simpler. It's a lot more conducive to the reward versus the time spent in front of the computer. It's more conducive to having a nicer lifestyle, so you can do exactly the kind of things you chose trading in order to help fulfill. Now, there are lots of misconceptions with end-of-day trading, unfortunately. Sure enough, a lot of people who've been spending time on the saddle might actually consider end-of-day trading being merely for beginners and that they're kind of a lot more advanced because they trade the 5-minute chart. Complete and utter nonsense. Actually, a lot of people who I've mentored, bearing in mind I've personally coached over 1,000 people worldwide, actually start off end-of-day trading, curiosity gets the better of them, they go into intraday trading, and then they come back with their tail between their legs and say, actually, you know what, I want to go back to end of day trading. You tell me exactly what I got to do. And I do that. Absolutely no problem. I've been there as well. In fact, a lot of people I know have been there as well, whether they're a friend, colleague, business partner, associate, client. A lot of people have been there. They have essentially rolled with the punches. But you don't have to. If only you stick to the daily and choose the exact style of strategy which will teach you. A lot of people consider end-of-day trading not to be as lucrative as intraday trading. Well, that's completely utter tosh, as I've written here. Intraday trading is low reward, high frequency, whereas end-of-day is low frequency, high reward. So you could arguably say they cancel each other out essentially, and you can get very similar results if you're a profitable and consistent trader. The difference is between an end-of-day trader and an intraday trader, like I've just mentioned, is that if you're an end-of-day trader trading fewer trades at a lower frequency and spending a lot less time on it, then you've got a much better reward for the time spent in front of the screen than you have if you're spending 3 hours a day intraday trading in front of the screen. Yep, it's commonly said that trading the daily time frame is boring. Sure enough, it is. But we don't really want trading to be exciting. It's a very amateurish thing to actually suffer from the fear of missing out, and that's what a lot of people who don't know what the hell they're doing in the market suffer from. The insatiable appetite to justify the time spent in front of the screen and the instant gratification wanted through just placing trades and wanting instant results from that. Whereas the market doesn't actually owe us anything. It doesn't care who you are, what you do, who you support, what your religion is. It will do its thing, and it's up to us as profitable traders to sit back and diligently wait for our chosen setup and trade it only when it occurs. Right, these are the general pillars or secrets of success that we generally adhere to. Always choose a high reward to risk strategy of a 3-to-1 at least, so that you know that even if you risk 1% of your account, you know that you're in pursuit of a 3-to-1 or a 5-to-1, so that even if you lose that 1% if you're wrong, that at least when you're right or the market proves you right, that at least you have a high potential of actually hitting target and getting 5% return for your 1% risk. Always risk only 1% of your account. Now, this is absolutely crucial, and this is where a lot of people fall down on, risking 1% of their account. But through not doing this, they generally don't even know about risk management and typically just dash on like 10%, 20%, 30%, even more sometimes, just because they have to be proved right, and they just want the instant gratification. And the whole greed mentality kicks in. Always have your rules for entry, management, and exits. Now, a lot of people, again, who are new to the markets don't know anything about this. Their rules, you ask them, what are their rules? If it comes apparent that they're actually trading already, they look at you absolutely nonplussed. It makes sense to actually have a strategy before going into the market, just like any business into any kind of retail environment would have a strategy or a plan. Only trade when your rules are met. Now, this is the big one. Sometimes it's very frustrating when you're in front of the screen waiting for your chosen setup to occur, and it doesn't occur. So that's why, again, we choose end-of-day trading, because at least you only need to look at the screen for 10 minutes a day, going through the different currency pairs. Is a setup there? No, we move on. Is a setup on cable there? No, we move on. Is it there on euro-dollar? No, we move on. Is there a setup on New Zealand Kiwi? Sorry, New Zealand yen? Yes? Okay, great. We give it further investigation then, if that happens. And then if it fulfills our rules, we take the trade. Another one is, of course, once you know your strategy and you're comfortable with what you're doing, do not let others cause you to break your rules. Everyone generally has an opinion of the market, whether they're a trader, a speculator, they read the news, they trade stocks or anything like that, but it doesn't mean they know Forex or indeed are profitable. So if you have an opinion that a particular currency or instrument is going a particular way based on a strategy, don't let others infect you with it. It's very often that happens, especially when there's ego attached to the outcome of a trade, whether you're right or wrong. And of course, if you're wrong and the guy or girl who says, oh, well, I think it's going to go the other way, and you've proven wrong, they'll probably say, oh, I told you so, not realizing that if you've got a proven strategy, every losing trade is one step closer to a winning trade. Just like if you're a salesperson, every no on the end of the call, if you're a cold call up, is one step closer to a yes. And again, when you're in your trade and it's going either for or against you, stick to your plan. and don't fiddle around with it, whatever you do, because you could find out you might move your stop loss very close to your entry. You get stopped out at break even or a loss or even a small gain, and then it goes completely in your direction. And finally, have a punishment and reward system. This will really help you to ingrain your plan, because losing money is bad enough if you're wrong and you break your rules, but if you can feel it in other ways, then you're a lot more likely to actually stick to them. So whatever it is, just stick with something you just like immensely. I'm reading Gordon Brown's autobiography for every time I break my rules, which fortunately isn't very often. But I'm pretty sure you could think of more creative ones than that. Okay, so this sticking to the plan is absolutely essential, even if it means not trading for days or weeks. We want complete faith in our setup. Our setup is our edge in a market of chaotic randomness. And that's, I'm afraid, ladies and gentlemen, is the Forex market. It's a market of complete and utter chaos. And it's our job as traders to find order within this chaos. Okay, ladies and gentlemen, I'm just going to talk to you about a couple of trades, some winners, some losers. I thought I'll give you the full scorecard here because, you know, if I was to talk about my winners the whole time, that would not be real life. Losing some trades is a part of trading. It's a part of real life. And this is a trade call we took towards the end of May. For some of our clients, actually, it's still in motion, and it's pound New Zealand shorts. And if we look on the weekly here, we can see it's in a general downward trend. So our overall bias is, lo and behold, short. And now if we pan down to the daily, we can see that, okay, we've got good cyclicity to the downside. As we zoom into the more of the recent days, weeks, we can see that you've got this decent level of resistance, which hasn't been penetrated for quite some time, for over a year. So on May the 22nd, I believe, we took this high test bar short at the top of what is essentially a long-term range, and with the view to potentially taking it all the way down here. There's nothing difficult about selling at the top of the range and buying at the bottom, for example. So, of course, currently price action is currently here, so we're waiting for it to go long when it gets to this level of support. And certainly those clients who are in the trade at the moment, still from May the 22nd, they would have been in this trade for flipping ages, and it probably would have felt like an eternity. But if you consider the fact that they have actually risked roughly about 189 pips in pursuit of, currently they're up almost 2,000, that's a 10% gain. Pretty much, just shy of a 10% gain. Okay, and they haven't even hit profit yet. So when you're making 10%, even though it might have taken 2 or 3 months to hit profit, and it's only one trade, one currency out of 26 choices, that's pretty good going. And these are typically the kind of trades we go for. Even if it's like a trade every week or every 2 weeks, or even like a couple of trades a month, with that reward to risk profile, that to us is the best kind of reward we can get for the short amount of time it's spent us to actually identify and trade the trade. It took us about 10 minutes to identify something like this, and sure enough, when it's in motion, we kind of go about our daily lives, not really looking at the charts, not really caring about it, to be honest with you, because we know that if we're wrong, we lose 1%, or however much we risk per trade, usually 1%, 2% absolutely max. But if we are right, generally we get our reward to risk profile hit. So in this case, it's 13 to 1. So if we're right, we make 30%. If we're wrong, we lose 1. Simple as that. And here's EuroCAD, a more recent trade we took. We saw that this low test here was actually on the 15-year low. And we had a view that it was going to go long off the back of it, because if it's a well-established level, which actually is a 15-year low, there's going to be a perception that there's going to be a good value for buyers at this level. So we bought it, and lo and behold, we got stopped out and we lost 1%. However, if we were right, we would have gained a fantastic amount, between 5 and 10%. If we took it all the way up to here or here. So hopefully this gives you a flavor as to how we trade and how we look at the markets. Thank you very much, ladies and gentlemen. I'm Rob Colville from the Lazy Trader.